Welcome to the Real Vision Daily Briefing. It's Wednesday, February 2nd, 2022. I'm Ash Bennington, joined today by Darius Dale, CEO of 42 Macro. Welcome, Darius. A lot going on today to talk about. Before we jump in with Darius, it's been a busy day. The U.S. is currently deploying 3,000 troops to Eastern Europe amid the deepening crisis between Ukraine and Russia in the region. ADP payrolls fell just over 300,000 payrolls in January. Here's why that matters. It wasn't priced in. The consensus forecast was for growth of 200,000 to 250,000 additional payrolls, depending upon the forecast you looked at. 10-year Treasury yields declined. All eyes now turn to the non-farm payroll report this Friday, and of course, to the next Fed meeting in the Ides of March. Darius, it's a pleasure to have you here with us today. Obviously, a very busy day. Give us some context. How do you think about what's happening right now in markets?
Yeah, Ash, it's great to be with you guys. I think I short sold the lows of northeast weather and packed up for some sunnier pastures for the next few months. So thanks for having me in from South Florida. But
brilliant trade, Darius. A brilliant trade.
Look, I mean, I fancy myself decent at trading, so let's keep it moving. But yeah, let's unpack the ADP number real quick. So we had the year-over-year number slowed to 4.7%. That's the lowest print we've seen in a few months, but more importantly, obviously, it was the big slowdown on the sequential to down 301K. That's the lowest print we've seen since April of 2020. There's a couple things that I think are important there. One, I think there's a pocket of consensus that very much believes the Fed put is not necessarily where it has been in recent years, but not significantly lower than where it has been in recent years. And so that pocket of consensus obviously saw a print like this today and said, hey, look, this will back the Fed off of the more hawkish scenarios out there with respect to their policy tightening and their normalization drive.
Can you describe or characterize what that consensus was? I know we heard stories of 7 rate hikes, 175 basis points. What's your take on that? That's the hawkish view, at least. What's your take on that, and how would you explain that to people who don't follow monetary policy as closely as you do?
Yeah, so the range of probable outcomes is wide, but not only it's wide in terms of the actual outcomes, but the whole entire sort of distribution has shifted right in the direction of hawkish policy in recent months over the last 2 months. And so, we went from saying, hey, maybe 3 to 4 hikes to definitely 4 hikes, potentially 5. Now 6 is really being discussed among certain policymakers. If you think about Bullitt's notes yesterday and Bostic's notes last week. And so that hawkish right tail continues to grow in terms of the probability associated with that sliver of the distribution. And so that is the sort of kind of hawkish tail out there. There's still a dovish consensus amongst investors that says, hey, look, this Fed can't get up to, wherever it's sort of projecting from a terminal Fed funds rate perspective. And we're already seeing that priced in the overnight index swaps, the Eurodollar futures curves, in terms of having a fairly low terminal Fed funds rate of 1.75 or 2%, pick your market. So that pocket of consensus is buying stocks today on this slowdown in job creation.
Yeah, and by the way, we should probably say U.S. equity markets up now for the 4th day in a row. S&P 500 closing up about 0.95% on the day. NASDAQ up about 0.5% on the day. Obviously, some bullish tailwinds here.
Yeah, definitely. I mean, look, the bullish tailwinds are more technical than anything. And I don't mean sort of, technical analysis like 200-day moving averages. I mean more like technical sort of aspects of the supply and demand functions within the derivative space. The options market dynamics heading into late last week, or really going back to the lows of OPEX last Monday, became incredibly favorable for an upside for relief rally. This is something we've been calling out in our morning notes and over the weekend in our weekly presentations. So if you think about a lot of those dynamics, what happens when you sort of have these big sell-offs and investors rush to buy protection, as they did into the most recent OPEX episode that culminated with that big V bottom on last Monday. That options premium, if the VIX does nothing, it starts to decay pretty substantially from those levels. If the VIX starts to go down, which obviously it's gone down a considerable amount since touching just shy of 40, last Monday, that is creating this sort of what I call a Vanna chase, this sort of Vanna dynamic where volatility compresses, dealers unwind their short put hedges, and the market tends to get a favorable boost from there. So that's exactly what we've seen, since, kind of starting last Friday, and it's obviously carried over into today. That was further aided and abetted again by the fundamental dynamic of a slowing jobs market that may, back off some traders from their expectations of tighter policy.
Darius, I'd be remiss if I didn't ask Vanna. So second order Greek, jargon alert, give us the context for what it means.
Yeah. So I'll start by saying I'm certainly no options expert. There are much smarter people on this that I continue to be educated by. Obviously, Jim Carson over Kai Volatility, Brent Kachuba over at Spot Gamut, Imran Laka over at Option Insight. Those guys, definitely go check out their work because I learned a tremendous amount from them. But in terms of my understanding of these dynamics, when volatility compresses, dealers have the opportunity as a function of, sort of being, particularly whenever they're short gamma, they have an opportunity to cover a lot of their hedges in their delta hedges in the underlying securities, particularly the index options, where they were sort of heavily, puts were heavily bought into that decline. And so they're now unwinding those hedges, and the act of unwinding those hedges creates a persistent bid in the market that ultimately gets sort of, that filters through into other asset classes clearly.
Yeah. So I wanted to ask you about something else that you've been talking about here on Real Vision and elsewhere. I wanted to give you the opportunity, Darius, to do a little bit of an end zone dance on your forecast on peak supply chain disruption. Tell us a little bit about that, because you were ahead of the curve on this.
Yeah, absolutely. So we start to see this in our data and company commentary going back to November. It looked like supply chain disruptions were in fact peaking in that month, and we started to call it out and say, hey, look, some of the indicators that we watch and study to give us a real-time view on supply chain disruptions, namely the Baltic Dry Index, the ISM supplier delivery times components, and all the subcomponents within those subcomponents. Those are all actually starting to peak and roll over, and we actually got that data yesterday, the most recent update for the month of January. The ISM, the percentage of respondents in the ISM manufacturing survey, that actually ticked down to 34.4. That's the lowest print we've seen since November of 20. So we're seeing this in auto sales. Massive jump in auto sales in the month of January, to plus 2.6 million to a SAR of 15 million. That's the highest SAR we've seen since June of 21, and the fastest, increase acceleration we've seen since May of 2020.
This is seasonally adjusted annualized rate.
Yeah, exactly. So effectively buying 15 million cars on an annualized basis. And so we saw that in GM's numbers. We saw that in Apple's commentary last week. And I suspect, as we progress throughout the first half of this year, we're going to see increasing company commentary around the amelioration of supply chain disruptions, particularly when we get past the peak impact of Omicron, because Omicron is clearly having an economic impact, as evidenced by the ADP data, as evidenced by the consumer confidence data and some of the business confidence data we're receiving from not just the U.S. economy but the global economy for the month of January and in early preliminary reads for the month of February. But we're going to get past that, and as we get past that, it's a positive tailwind for growth at the margin, and it's a headwind for inflation at the margin. So you could get this sort of bounce, sort of bouncing growth, starting in February, March, and you could get this sort of accelerated decline in inflation, kind of starting in that same time frame.
Yeah. By the way, you mentioned the Baltic Dry Index, obviously a measure of shipping traffic. I wanted to hit a clip here from a show that came on Real Vision today. It's Matt McCleary interviewing Jay Minsamer on Real Vision today, available on the Essential Plus and Pro tier. It's called "It's Time to Talk About Global Shipping and Scarcity Value." Let's take a look at the clip.
A year ago, folks were asking about inflation. And I said, look, I'm not scared of hyperinflation. I'm not saying, we're going to be like Zimbabwe or something, but I have been a little bit concerned about inflationary pressures. And I've told folks, look, if there's going to be runaway inflation of any kind, shipping is like the best place to be. You're talking about real solid assets that are a commodity. What happens when inflation goes on, right? Commodities track inflation. The value of a hard asset follows inflation. And if your debt is fixed, right, the real value of your debt goes down. So if your value of your asset goes up and your debt goes down, your equity returns could be exponential. And, I'm not one of those guys that says there's going to be hyperinflation for several years. But if you are worried about inflation, I think shipping is one of the best places to be.
Well, there you have it. Super interesting context around the shipping trade, something I didn't know about myself. But big picture, Darius, he's talking about this as an inflation trade, a commodities trade. To that point, Darius, what are your thoughts?
Yeah, so if you, so I'll start by saying, I think that the title of the video is, this is time to talk about shipping. I would argue it's probably time to talk about shipping a year ago. Not saying that he's wrong. I'm not questioning his thesis, but shipping has outperformed the S&P. If you look at the selective, I want to say selective global shipping index, it's up 80% on a year-over-year basis, 84% on a year-over-year basis, and that obviously is about 4x or a little bit more than 4x what the S&P 500 itself has done. So clearly, demonstrable outperformance has obviously been met with some very improving fundamentals. Now, the problem with those fundamentals is they're not necessarily secular. Investors have been burned many a times in cycles before in terms of overbuilding capacity in this particular space. And so I don't know that understanding that a lot of these dynamics are, sort of impulse related to aggressive fiscal stimulus in the U.S. and other pockets of the world during COVID that might not actually come to fruition or be sort of repeat orders as we progress throughout 2022 and 2023. So that makes this a little bit tougher of a trade to get into at this particular juncture. But I will say this. I wouldn't necessarily view shipping as an inflation hedge. In our opinion, at least according to our models, it's a better deflation hedge. It tends to be a lower beta sector that outperforms both the market and anything cyclical from a high beta cyclical perspective. Whenever you're in deflation, and what we call deflation is that's when growth and inflation are slowing simultaneously. That tends to be much higher volatility, rising credit spreads. Equity returns tend to be negative, particularly when that deflation, the deltas on growth and inflation are large in magnitude.
Talking of which, what are your thoughts on the gold trade? I know you've been looking into that.
Oh, I'm an idiot on gold, man. I got nothing for you. No, I wish I had it. I mean, gold has certainly confounded me. It's one of the places you're going to want to, let me start. It's one of the places you should be flowing assets to in anticipation of a deflation trade morphing, really materializing, in our opinion, later this year. Again, our target on that is still sort of springtime, when you would likely see sort of real pickup in cross asset volatility that could potentially persist and trend. Because again, it's our view, and we very much disagree with the pocket of consensus that we highlighted earlier at the show. With that pocket of consensus, I think the Fed put is not significantly lower than from where it has been in recent years. They believe that this is a Fed that is overly concerned about financial conditions and overly concerned about the growth outlook. And therefore, if we start to see a tightening of financial conditions, that'll be quick to back off and quick to pivot. It is our interpretation that based on the tightness in the labor market, and this is something I've been talking about on this program for several months now, based on the tightness in the labor market and based on the stickiness of inflation, even though inflation is likely to be decelerating, starting in kind of in the January, February period, we might get one more month of acceleration, but starting in February, more than likely, we'll see inflation decelerating. Even though it's decelerating, it'll be high and sticky. And more importantly, at every interval that the Fed will have a decision to make with respect to hiking interest rates and or commencing its quantitative tightening program, inflation is likely to be above their target. So you'll have both of their dual mandates not only being met, but also being met to a threatening degree that actually threatens the broader business cycle. Don't forget, one of the charts I sent you, Brian, is a chart that shows the unemployment rate relative to the Fed funds rate. And this is data we have going back to the 70s in terms of the Fed funds rate. And you can see by those black dotted lines in that chart, the Fed has never been this behind the curve. This is the latest they've ever been with respect to the labor market cycle in terms of initiating a tightening regime. The unemployment rate being where it is at 3.9%.
Right.
And so to me, I think that's a scary situation as it relates to the yield curve is signaling, hey, look, we're heading into a growth slowdown already. You're probably going to make this worse by tightening. And I think we, as investors, would be very remiss to put a lot of faith in this Fed's ability to sort of thread that needle. I mean, this is the same Fed that a year ago was telling us there was going to be no inflation. And so now this is the same Fed that's telling us today that don't worry about the growth outlook. And to me, I'm a little bit nervous about that.
Yeah, and also the same Fed that told us that inflation was transitory just a few months ago after retiring that word.
After retiring, exactly.
The choice of Chair Powell. But listen, this speaks to something that we've talked about here on this show and elsewhere on Real Vision, which is this notion about how the Fed is trying to thread this line between the Scylla and Charybdis here. They've got this challenge on both sides of the dual mandate. And so it's probably not surprising to see what we see on that chart, which is kind of uncharted waters in terms of the ability to fix these challenges that they have. How do you balance this out when things are going wrong on both sides of the dual mandate?
Yeah, no, I think Jay Powell gave you a clear indication of how they plan to balance it out, which is do more than the market potentially expects, or at the bare minimum, condition the market for them potentially doing more. I think the side that they're erring on the side of doing more, not less, in our opinion. I think that's become very clear, certainly to the overnight index swaps market and the Eurodollar market. May not have become clear to everybody participating in the cryptocurrency space or in the equity market, but it's certainly clear to rates traders and then money market traders. It'll become very clear to everyone in risk assets once the Fed starts to shrink its balance sheet. And as we heard from Jay Powell last week, that could commence as soon as April. Like we were always out there with this July, set it and forget it quantitative tightening program. That could start as soon as April. And a lot of investors, Joseph Wong, Alfonso Pecatiel, have done a tremendous amount of work on what it actually means to act for the Fed to shrink its balance sheet. Because it's not just this sort of dynamic. It's not just this behavioral dynamic where people get bearish because the Fed balance sheet chart is going down. No, there's a lot of actual technical factors that are contributing to a reduction in financial leverage and a tightening of financial conditions as well behind the scenes. So that's going to be a problem, in our opinion. And it's our view that this Fed does not have an off ramp from its policy normalization agenda until the labor market starts to stumble, because inflation won't slow fast enough in terms of getting to a at or near target rate, in terms of the next kind of several quarters. And so the only thing that, in our opinion, that could back them off is either a sort of backup in the unemployment rate that is of consequence, or more importantly, a steep drawdown in the equity market or big blowout in credit spreads that tighten financial conditions. But it's our job as investors, Ash, right, is to front run the big blowout in credit spreads or the big drawdown in the equity market. So we can't use that as our proxy for, okay, the Fed's about to pivot dovish, because they will have lost money. And so understanding that is the thing we're trying to forecast. We have to look at the other things, and the other things won't change quickly enough before the main thing could change. So to me, I think that's the big risk of investors face this year, is a Fed that is, I wouldn't say on autopilot, but they just don't have an off ramp from this policy normalization drive for several quarters. And that's a couple of careers away as it relates to managing risk in this market.
Right, but let me ask you this, Darius. You talk about the normalization of the unemployment rate, but is that really the best proxy? It seems like we're seeing this breakdown in historical correlations. We're seeing this fragmentation of the labor picture. The unemployment rate is normalized. You've got these really positive JOLTS numbers: 4.3 million for the month of December, off just a little bit from 4.5 million in November. These are huge numbers. A 1 million print on the JOLTS report for quits was considered very high just, whatever. 2 years ago, those were extraordinary numbers, and now we're seeing these very strong quits numbers, while at the same time we're still down whatever the number is from peak, 3.5 million jobs. It's not showing up in the unemployment rate and the U3 rate. It's showing up in some alternate methods of labor underutilization, and also clearly in things like folks leaving the labor market. How valid are these benchmarks that the Fed is trying to optimize for on the labor side?
Yeah, no, they're only as valid as as they are, right? I mean, the reality is at any given time, there's always some sort of funky dynamics. Clearly, the pandemic has thrown a very large wrench into anybody's labor market analysis. But I think you sort of have to piece it all together by taking a holistic approach as you do. So let's start by saying, okay, look at there's an employment to population ratio. That's probably the cleanest measure of how the labor market is doing at any given time, right? You don't have to worry about the labor force participation and how people classify themselves and things of that nature. Just how many people have jobs relative to the total population. That number is at 59.5% in December. That's 170 basis points shy of its February 2020 cycle peak. And so that number, the fact that that number is so shy, is telling you that the labor market may not be as tight as the wage dynamics, as sort of the fear out there is. But then you have to go back and look at the actual labor force participation rate. There's a couple that haven't budged in a really long time, namely the labor force participation rate for prime working age individuals. At the 25 to 54-year-old labor force participation rate has been stuck at 81.9% since July. And then the 55-year-old labor force participation rate, this is the great retirement, the great resignation, or not necessarily resignation, but it's the people who retired early, who don't want to risk their lives at work, making, whatever bucks an hour. That labor force participation rate has been stuck at 38.5 really since last December, not like almost a calendar year. And so there's clearly something going on in the labor market that says not as many people want to work and need or need a job as they have in prior years, right? We know household net worth is up about $18 trillion relative to its 5-year trend line through 2019. There's a lot more wealth on consumer balance sheets. There's about 2.6 trillion in excess savings, according to our calculations. So there may be a lot of households who just don't need to work as much, or people who are nearing retirement and looking at their 401ks and saying, hey, let's just hit the bid on this, or sorry, lift the offer on this. And so I do think those labor market dynamics mean something today, because ultimately what it means is that the economy is in fact closer to full employment. And full employment, again, is a cyclical dynamic. It's not a structural static number. According to today's economy, we are close to full employment, and that's exactly what we're seeing in the second chart I want to bring up, which is the employment cost index relative to the quits rate. We saw the quits rate data tick down 20 basis points in the December number, but it's still, it's just off an all-time high of 3.4%. But that number continues to drag up the employment cost index, which is the broadest measure of wages and benefits and salaries and things like that in the economy. That 4% number in Q4 is the fastest growth rate we've seen since Q4 of 2001. All right, like that's 20 years ago. I mean, I'm guessing a third of people watching this weren't even born in 2001. Or some large percentage based on their interest in the cryptocurrency market. So, this is a big deal. Like, irrespective of whether or not it's real or not, it's occurring. And the Fed and the fact that it's occurring, the longer it persists, the more likely it is these dynamics start to get entrenched and they start to feed upon themselves and compound at higher levels, right? Compounding at 4% wages is very different than compounding at 2% wages. Compounding at, 7% inflation, or somewhere between 5 and 7%, is very different than compounding at 2 to 3% if you talk about where will prices be 3, 4, 5, 6, 7 years from now.
Yeah. So many important points there. Darius, there's something that you touched on a number of times, and I wanted to give it a little bit of a deep dive here because I think it's an important one. You've talked about financial conditions. You've talked about Eurodollar market, things like OIS, LIBOR, TED spreads, all of these measures of tightness in these in financial conditions. This is very much, I think, something that institutional investors think about a great deal. Retail investors, not so much. Give us the 50,000-foot overview on financial conditions. First of all, what they are, the intro, the context, and then where they are now.
Yeah, so financial conditions, I guess the simplest way to think about it is, how easy is it for consumers and businesses to obtain leverage? Right? Is it easy for companies to go to the debt market and sort of ask borrower or ask creditors for more money to roll over existing debt, money to finance new projects, new M&A, things of that nature? Is it easy for consumers to go sort of, go to their bank and take on more debt, more leverage? And that's, so there's all sorts of measures in terms of how we track financial conditions. But I guess the most sort of main measures that most people look at would be obviously the price of the stock market. It would be the level of volatility of the stock market. VIX is probably most commonly cited indicator. It would be level of credit spreads. That's probably the most direct consequence of the tightening or easing financial conditions in terms of the additional amount of lenders charge borrowers relative to treasuries, relative to similar maturity treasuries to take on that credit risk. And then the U.S. dollar tends to be a decent feature in a lot of financial conditions models as well. So, when you add it all up, we've seen volatility rise. We've seen credit spreads rise, albeit marginally. We've seen, obviously, a pretty big, strong move in the dollar in recent months. And then lastly, obviously, we've just seen our first 10% correction in the stock market since fall of 2020. And so very clearly, financial conditions are tightening at the margins. And as long as they continue to tighten, it's going to slow growth. So the Fed has accomplished some of its policy tightening already just by talking. Forward guidance has already tightened monetary policy. It's already tightened financial conditions. But they do need to follow through with what's out there in the market in terms of the pricing in Eurodollar curves and OIS curves, because if they don't, it'll effectively be an easing. If we get to March and they don't hike interest rates in March, that's a 25 basis point rate cut according to the market, and that would loosen financial conditions and actually shoot themselves in the foot and go backwards relative to their desire to tighten, to effectively bring inflation down and ultimately cool the labor market and cool the economy to a degree, to a finely threaded degree that allows inflation to get back into their target.
Boy, it's a very fine thread indeed. We should say DXY US dollar index now closing out the day here. It looks right around 96. It is up materially from where it was 12 months ago, trading at around 90 and change. So a big move there in dollar. And so Let's talk. One other question for you, Darius, something I mentioned at the top of the show. I mentioned this story coming out of Eastern Europe, the United States committing 3,000 additional troops in the wake of the Ukraine crisis. What are your thoughts? How do you think about those sorts of kind of outlier scenarios? How do you attempt to factor them into your model? And how are you looking at this one?
Yeah, so I'll start by saying, investors have to have their edge. My edge is not on understanding geopolitical dynamics. It's certainly not on understanding all the ins and outs of the options market. My edge is on, sequencing economic data, and building econometric models that are accurate in forecasting growth and inflation, and ultimately front running what policymakers are going to do about those changes. So that's my edge, and ultimately what asset markets are likely to do about all of that. That's my edge. And so sticking to my edge, we built a system, a robust system of tools at 42 Macro that allows us to sort of dynamically adjust and one, dynamically observe big changes in sort of the market regime, big changes in the economic regime. I think we built some pretty good models that give us a leading edge on that. So that's my long-winded way of saying, hey, if this stuff actually matters, it'll show up in one of these tools. It'll show up in our market regime nowcasting process. It'll show up in our macro regime nowcasting process in terms of what the economy is doing. If something like crude oil, rallying tremendously really starts to have an impact on consumer spending, and I would argue it already has. Like a couple more charts I'll pull up before we wrap up. The chart showing real disposable personal income per capita in the month of December. So, we got this data last week, and, certainly didn't make enough headlines in my opinion. Obviously we got the GDP print and all that stuff is making a lot of noise, but this real disposable personal income per capita number contracted at 3% on an annualized basis in December. Like that's a big deal. We're so numb to these numbers in COVID, but that'd be like, oh my God, that's a recessionary print. That's the biggest, steepest contraction we've seen since June. And that had impact in terms of slowing consumer spending. Consumer spending, real PCE, if I got that chart as well, that contracted at a minus 12% SAR in the month of December. So effectively, the consumer spending, the broadest measure of consumer spending on a real basis, contracted at a 12% annualized pace. I mean, that'd be one of the deepest recessions ever if we actually saw that on a quarterly basis, on a multi-quarter basis. And so that's a big deal in terms of the bite to consumer spending that we're already seeing. And this has nothing to do with Omicron. I mean, Omicron certainly slowed services consumption. It was up at a 1% SAR, but really the big tail in terms of these week data are the goods consumption component, contracted at a 32% annualized pace. I've been talking about this again. Another thing we've been discussing for a while in this program, there's an overconsumption of goods in the U.S. economy. I've made the same tired joke many times, but when I sit at my desk all day, I have 7 pairs of these super comfortable, kind of like yoga style Nike shorts. They're really awesome. I love them. There's 7 pairs. I'm not trying to run my washing machine, 5 times a week. And so, I'm not going to buy an 8th pair. There's only 7 days in a week. And so how many people have bought a washing machine, a car, a house, and don't need a second washing machine, a second car, a second dishwashing machine?
Yeah.
I think that overconsumption of goods, particularly any goods, the big ticket items associated with the housing market dynamics, that stuff there's going to be a hangover there. And we're already kind of starting to see it from a macro perspective, right? Go back to the last 2 GDP prints. Inventories is more than 70% of both of those numbers.
Yeah, it's
Q3, Q4.
It's this phenomenon of demand getting pulled forward. And by the way, at the darkest point in the crisis, I couldn't buy more Adidas running pants because they were sold out in my size. But listen, I wanted to touch on something here because I wanted to get in at least one question from our viewers today because we've got some good ones here. Talking about your edge and what's right in your wheelhouse. This one comes to us from Mashu N from the Exchange. And the question is, if payroll numbers disappoint on Friday, can we expect to see longer end yields fall off? And then he has a follow-up for that. And how do you think gold will react?
Yeah, I think the payrolls are a sideshow at this point. They've been for a while now. It's all about the tightness in the labor market, as evidenced by the labor force participation rates, and it's also about the wage dynamics. Will we see an acceleration in wages? And if we saw an acceleration in wages, quite frankly, I think the declining payrolls number actually might inflate wages in terms of reducing supply from the overall supply-demand imbalance that we're already seeing in the labor market. So to me, I think wages going up is the real big story that could potentially shock markets relative to what we see in price in the markets today. I'm not saying it's going to happen. I mean, I don't know anybody at the BLS, but it definitely is a more than reasonable probability.
Hey, one more because it's right in your wheelhouse. This one comes to us from Vikas Lakota from the Real Vision site. And the question is, any thoughts on the impact of high natural gas and oil prices on a rate of cooling of inflation and the expected Fed response to it?
Yeah, so I want to be specific about this, and I'll bring it up next week. But in terms of inflation, right? So inflation is a percentage change statistic, right? So you need the base effect. You need to understand what the comparative base is, and you need to understand what the sequential momentum is. So if the sequential momentum is less than the base effect changes, the sequential momentum and the base effect, the year-over-year statistic will go down. And so we're kind of getting to the point in the calculus in terms of the matrix where the sequential momentum, even if it's sustained, will catalyze, even if it's sustained at these, obviously very aggressive rates, will still perpetuate its declining year-over-year rate of change as a function of the sequential momentum we observed in the models last year, right? Like we had this massive run-up in the first half of last year in a lot of inflation statistics. Go back to that. Remember that April inflation report that was like bang, shot across the bow.
Yeah.
We saw it again, I want to say, in the June inflation report. Again, we saw it in the October inflation report as well.
Well, it was just transitory then, Darius.
Yeah, no, exactly. This is back when transitory itself was building momentum still. It's obviously gone by the wayside.
Yeah,
so
transitory was transitory.
Yeah, transitory was transitory. You're absolutely right, man. So yeah, that's a long-winded way of saying it. Yes, even if we continue to see these prices rise, they have to rise at a faster rate than what was observed last year in order for inflation to continue accelerating. If they rise at the same rate, then obviously inflation will stay the same. And if it rises at a slower rate, then the year-over-year statistics will start to decelerate. So it's not mathematically impossible, but it's going to be very difficult for us to sustain, sort of these year-over-year rates of change in inflation, particularly as we get into February, March, April.
Yeah. Hey, Darius, this has been a great conversation. I know you had a lot to get in here. Thank you so much for joining us again today.
Asher, the man, bro. Appreciate you guys. Thank you.
Thanks, Darius. And thanks again for watching the Real Vision Daily Briefing. Maggie will be here tomorrow with Michael Guyad. As always, the conversation continues on Real Vision's The Exchange.